Welcome to the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
With us, as always, our community manager, the one that brings us the moments that matter. And that's why we call her MTM, because she's also Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And it is good to be back in the studio, man.
Yeah, how about that, huh?
It's been a minute. We were running this morning. I want to welcome the YouTube audience. I want to welcome anybody that's listening on the podcast in a couple of days here or watching later on the YouTube replay. Love having you. Love having you. But what we'd really love is for you to come join us one of these Tuesdays or Thursdays, 12:30 in the afternoon, Eastern time. And go to nyais.com, register, you get a calendar invite. You can just jump in whenever, like, for example, you might get an update that says breaking news in Silicon Valley Bank. There's a run. Maybe you want to come chat about it with us. And what else do you see?
You get invited to take part in the roll call, baby.
The roll call, baby. We got our MVP Lee Bishop leading us off today with a hello, everybody. We got the ringmaster,
Andrew Barhill.
Andrew Barhill saying good day, all. We got Walt Hart in the house. Walt Hart is back, saying, hi, guys. We got Papa Cohen.
All right, Pops. Good to
Daddy,
see you, buddy.
Big Daddy, Greg's dad over here. We got our regulars, the second family of the Not Your Average Investor Show from Murrieta, California, Gary and Rosalind Riley. Did we salute?
We don't know what to do with the second family. We're still figuring this out.
All right, we're figuring it out. We got Denny Davis checking in from Germany. Guten Tag, Denny. We got Deborah, the witness. Schwartz, karaoke witness.
Can I get a witness?
Can I get a witness? Say hello, everybody, Deborah. We got Pablo Tolentino in the house. Good morning from the rainy San Francisco Bay Area.
New name?
We got a new name. It's a new name.
And a great name.
It's a great name. It's a great name, Pablo.
Welcome to the show, Pablo.
I commend you for your parents choosing a wonderful name. Jamie Crawford in the house. Teammate.
All right. JWB's finest right there.
JWB's finest. We got Chris Gonzaga from a little part of the country.
It's illustrious.
It's the illustrious
Hudson Valley
of New York. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
Saying good morning from a stormy Bay Area, California. We got Ernest Upperly saying hello, everybody.
I know Ernest.
You know Ernest.
You know Ernest.
For sure, Ernest.
Ernie, good to see you, brother. Thank you for being here.
Ernie, I forgot what your last name was, man. Good to have you here. We got John Moran checking in with us, Delray Beach, California. We got our favorite name to pronounce, Aaron O'Neill.
Into the light.
We got Sergio Preto.
Go Gators.
Go Gators, Sergio. Good to have you in the house. We got the fairy godmother in the house from Monterey, California.
Miss Jen Filson.
Where the atmospheric river continues. That's very fairy godmother of you to say something like that. We got Bill Shields saying, Feliz martes a todos. Thank you, Bill Shields. Feliz martes a ti también. We got Terry Ingram checking in from Orlando. Is Terry a new name?
New name?
Terry, welcome to the community.
Welcome to the party.
Good to have you. We got Greg number one.
The better Greg.
The better Greg. Greg Stone from snowy New Jersey. Pablo, don't get any ideas. We got Eddie Harris from Atlanta checking in. We got Eves Richard Doe. I know that Eves has corrected me before. It's like Eve.
Yes.
Who's joining us?
She's going to be the guest investor next week. We can't wait to have you.
Coming up from Maryland, checking in. Eves, good to have you. Pumped to meet you. We got Medj Garcia back in the house.
All right.
Medj, haven't seen you in a while. We got Robin Schofield from a snowy New Hampshire.
Fantastic.
Robin?
The name sounds
familiar.
But welcome to the show. We're happy to have you.
Welcome. Good to have you. Good to have you, Robin. We got Gerald Schwartz. Gerald from Herald. Howdy.
Gerald from Herald. I think that's built in right there.
Coming in with his own nickname. I love it, Gerald. Welcome to the show. Good to have you on board. We got our dear friend Leslie Wilson coming to us from Denver. Love to have you on board, Leslie. This is a big list today. We got the first families in the house from rainy San Francisco Bay, the patriarch and matriarch of the first family of the Not Your Average Investor Show, Ken and Caroline Melin. We salute you. We got Richard Coughlin from Detroit, Michigan, repping here.
All right.
Another new name. Richard, this is awesome. We got our friend Keitha Gianella from San Diego. Keitha, good to see you back on the show.
Keitha.
Corey Schultz from Milwaukee Airport on the way to Houston.
All right.
You know that
safe travels.
Milwaukee is it's an Algonquin name pronounced Milwaukee for the good land. Just
the look in your eyes as you were endearing me into that information was just incredible.
We got Tonya La Barbera from Jacksonville, Florida, in a JWB home. All right, Tonya, good to have you.
Oh, fantastic.
Yeah, this is great. All right, that's it. We got it done.
You guys came to play today. Fantastic. Thank you for being here.
Love having the new names. Love having you all. Remember, we got Mahesh Pagaku checking in just in time, saying hi.
Sneaking it in there.
Sneaking it in, Mahesh. Good to have you in here. This is our favorite content pillar. It's where we just come, sometimes we're teaching one whole subject, but sometimes we're showing up with the news of the day. This is the first time that we've ever been like, hey, it's Friday. We have something planned for Tuesday. Guess what? Plans have changed because the world changed overnight with this Silicon Valley bank run, right?
Right.
We haven't had a bank run since 2008. And the backstory to this, we've been obsessively researching it as it happened. Here's the way I understand it. If you're new to the show, you'll know I'm not the financial expert. Gregg is, but I can tell a story. So Silicon Valley Bank has a brand name bank of the Silicon Valley area, does a lot of work with VCs and VC funded companies, essentially has deals where you get your seed funding, you get your Series A funding, and you take those 2 million, 30 million, 100 million bucks, you deposit it with Silicon Valley Bank because they also have deals where when you're getting some debt funding, they require you to have the equity funding to be alongside of it, right? That's how they've built their equity thing, right? So Silicon Valley Bank, tons of cash on hand because of this VC money during a historic VC run of the past couple of years, money flying everywhere. They have all this cash there. To be safe, Silicon Valley Bank took a lot of that cash and invested it in bonds. In bonds, right? Long-term bonds at like 1.5% or whatever they were when they bought it.
Probably less than that.
Probably less than that. Recently, as the Fed has hiked interest rates, those bonds have been devalued. Right? Because of the yield curve or whatever. I don't know. I'm getting too far ahead of my britches. Let me just finish the story.
I can help there.
The bonds have lost value. At the same time, VC money has dried up, right? These companies that put their $100 million in burn rate in there to run their companies, they draw down that cash account to pay bills. A lot of these companies are based on customer acquisition that pays off in like a year, 2 year, 3 years, and they're making these bets to acquire all these customers to then gain on all this stuff. As all this is happening, Silicon Valley Bank puts out a message saying that they're going to fundraise to deal, since they had to sell these bonds at a discount, they're going to fundraise to solve some liquidity issues. That stirs up a couple of people, freaks them out. Famous investor Peter Thiel, I believe, either tweeted or sent out a message to a bunch of people saying, hey, if I were you, I'd get my money out of this bank. That spread like wildfire through the venture-backed kind of like startup community. It made everybody say, oh my God, like all these emails started coming out from these funds that were backing these companies saying, if you have money in this bank, take it out. All of a sudden, overnight, everybody's like crashing the website, taking their money out on Thursday. By Friday, there's a line outside the door of people trying to take out their money. By the end of Friday, Silicon Valley Bank has been called insolvent and shut down by the government, essentially. People were freaking out. This is payroll for companies, right? Like this is what people are going to use to pay their people, to pay their vendors, to pay off their loans or whatever they're doing has been taken out. The FDIC insures $250,000.
That's right.
In a personal bank account, but these companies have like $10 million, $60 million in there. So it's not insured.
85% of the deposits were uninsured. They were over that $250,000 threshold for this bank.
Correct. 85% of the deposits over that threshold for this bank. And what it starts doing, it creates this giant chink in the armor of the US banking system. People are freaking out that other regional banks, this is going to happen to them. They're worried about that. So what ended up happening is government steps in, government says, we're not going to give you a bailout, right? This is not what happened in 2008,
right?
But the deposited funds, so the company's funds that they're using for payroll is going to get covered by an FDIC insurance plan that kind of like other big banks pay into. And that burden is going to get carried by the rest of the banking system, not by taxpayer money. And what it's going to do is protect the deposits. It does not protect investor money in the bank, right? Like the stock of Silicon Valley Bank, it's gone. And anybody that invested in that bank, that money's gone. And I'm not sure kind of like derivatives of different investment types, but essentially when I hear this story, I thought my money is safe in a bank. And that happening. And by the way, I think my money's safe in my bank here in Jacksonville. So if something happens in a bank in Silicon Valley on the completely opposite side of the United States, I would have never thought that I would have to freak out about that. And the other thing that I'm hearing is like, it happened like a contagion, right? Like it's like, hey, something started blipping. One person with a big audience and a lot of influence sends out a bat signal, and all of a sudden there's this like mob mentality of something that's going to happen because of a couple minor mistakes get extremely exaggerated. How did I do?
I think you did really well.
Okay.
I think you did really well. I mean, I think, let me just jump on a couple of points there.
Yeah.
This idea of safety, right? Before, people think, the stock market is variable. People know that the stock market is variable. I wouldn't say that people think their money is safe in the stock market. They know they deal with a little bit of variability. But when you think about where people think their money is safe, they definitely think their money is safe in bonds.
Yep.
Right. So this idea that bonds have gone so far down in value is surprising to a lot of people. And there's a lot of ramifications and unintended consequences from the bond market doing what it's doing, being close to a bear bonds market, right? A bear bonds market. And that happens, just to kind of clarify, when yields go up in bonds, prices go down in bonds. And so what has the Fed done over the last 9 months is they've raised the interest rate, like they've raised the yield on the Fed funds rate at the fastest rise in the last 40 years. So that pushes bond yields up. And what that does is it reduces the price. It pushes the price of bonds down, which if you're a bond holder and you're holding to maturity, that's not a big deal. But if you're a bond holder and you need to sell the bond in the short run before maturity, which is the other part of the story with Silicon Valley Bank, their backstop in a case where they need to raise money quickly is to sell bonds. Well, they held those bonds. They bought them when the yield was way low. Now the yield on bonds is way high. So when they sell their bonds, they're taking major losses. So this idea that bonds were a safe place for a bank or for an investor out there to preserve your capital is being flipped upside its head because the Fed has had to raise interest rates so much. And the Fed does not want to raise interest rates this much, but they have to do it because inflation is such a big problem. So, it's just like, what do we think certain assets are safe, and then we think other ones are risky, and people lump real estate into this risky asset class. They lump rental properties into this risky asset class. But this idea of what's safe and what's not, people thought bonds were safe. Now, the next thing I thought, and I'm sure all of you thought, is when I put my money in a bank, that's even safer. And unfortunately, if the FDIC and the Fed and the Treasury and the government did not come together to basically insure these uninsured deposits, a lot of people, a lot of companies would be losing the money that they thought was safe in the bank. So I think we really need to evaluate and understand what is safe and what maybe just has inherent market risk because of the unintended consequences that come with rising interest rates like this.
Yeah. The interest rates piece is, the thing that I've been getting most educated on is the overall macroeconomic picture, right? Like you and I in this show, we talk a lot about interest rates, and that I understand it, I understand like the direct cause and effect of interest rates to real estate, to bonds or whatever, right? Like as I've unpeeled this onion, what I'm learning more and more about is this idea that, the historic nature of inflation, right? Like we have not been in an inflationary environment since the 70s, right? The danger of inflation, this idea that it's easy to, you can always stimulate the economy by lowering interest rates, but when inflation's going bananas, you got to control it at all costs because there's nothing to protect the average family from your gas price going up to like $12 a barrel or whatever, or not $12 a barrel, $12 a gallon, right. $12 a barrel, pretty good. That type of stuff. The idea that we have printed so much money over since the last inflationary time,
right,
that we continue to devalue the dollar, we continue to do whatever we want, and we're taking for granted the fact that we are the world's backstop. We are the world's de facto currency, and we came away from the gold standard temporarily in the 70s forever.
That didn't last.
Right. And, this idea that when that gig is up, that gig is up. Like we are the gold standard to the world until we're not. And I think when you put all these different kind of like cocktails together, it just screams of uncertainty, black swan events, weird things that are externalities that are going to happen when somebody lights a match in a completely interconnected world that has infinite options and free access to information and moving money.
Yeah, I think you're right. And I think the Fed understands this now. And I think the Fed is stuck between a rock and a hard place. I mean, the Fed does not want to raise interest rates like they have. They're doing that because of inflation, like you're talking about, but also because this is a super interconnected world like you're talking about. And our country needs to be prepared to handle the unexpected. And when you have inflation at over 6% right now and not going down as fast as we want, and you have a job market that's still on fire, and you're still adding hundreds of thousands of jobs every single month, and you have a balance sheet on the Fed of $9 trillion, which is money that has been printed and then just bought other bonds and mortgage-backed securities, what you've created is an environment where when something doesn't go according to plan, you don't have many options to solve the problem. Yep. And that's a scary thing for our country. That's kind of where we are. And that's why the Fed has been working so aggressively to get inflation. Once they finally figured out that inflation is not transitory, they went really strong with reducing the number of bond purchases first, which we talked about here on the show. And then they went really strong with interest rates. And it's because they realized that we need to get inflation down. But even more than that, we need to be prepared from a monetary policy perspective to handle the unexpected. And the unexpected is what just happened here. Yeah. And what the Fed did and the FDIC, if they can't handle it with lowering interest rates and they can't handle it with more QE, which is buying more bonds and mortgage-backed securities. They can't do that right now. What do? They come up with another tool.
Yeah.
And so the tool that they created here was a way to, have the uninsured deposits covered by other banks. Apparently, and I don't know all of this stuff, so forgive me if I don't know everything. We're still kind of going through this, but what I have come to understand is that as a part of the FDIC, they can assess fees on other member banks. And so that will cover the uninsured deposits. But then everybody else, all these other investors, you and me are out there are saying, okay, insured deposits, that makes me feel good that people who are putting their money in the bank are not going to lose it. But let me start to take a look at all of these other banks that have a similar profile of loans and where their money comes from. And could they be the next one to go under?
Yeah.
And so now what they've created, this new tool that they've created is basically a short-term loan program where banks, and I don't know how they qualify for this, but banks can basically, instead of having to sell those treasuries and those bonds to be able to come up with capital in the event of a bank run, they can pledge that to the FDIC or this new entity that's been created, and they can get a short-term loan with very low interest rates. So they don't have to sell these bonds at major losses to come up with capital. They can get a loan. And this is going to reduce the exposure that something like this could happen again. But this is another tool that the Fed had to create. And the Fed does not want to create new tools. QE was a new tool that we created. Yeah. So this is another tool. And that, again, has unintended consequences.
Interesting. So to not be too alarmist, right? I want to give credence to what Matt Frazier just said here in the chat. Keep in mind that most responsible financial institutions hedge out of the IR. IR is interest rates. Hedge out of the interest rate and duration risk on their bonds. So this is not as big of a problem. For some reason, SVB, Silicon Valley Bank, did not do this. They did not do the basic balance sheet management activities that are standard for large banks, right? And Leo's also saying, his friend, right? I know the First Family, the Malines, they're in the Bay Area. I know we have somebody else here that's also in the Bay Area, Eileen Mateos, right? Also in the Bay Area, very much affected by this stress. Leo's talking about his friends being worried about payroll and stuff not covering. From everything that we know, this disaster has been contained for right now, right? Like this tool has been, a fire blanket has been thrown over it. and people are going to get their payroll. They've created this new tool. To be perfectly honest, I like the idea of this thing being a kind of like insurance plan that banks pay into to pay this thing down, and it not going down to like taxpayers.
Right.
It's not bailing out speculative investments. It's bailing out, basically payroll stuff and things that you should feel secure in, right? Like, I like this tool. The question that we're bringing up is this idea of, we just invented a new tool. What does this mean, right? Like, for me, I've been talking since the GameStop fiasco, right? Since the Wall Street bets, where internet chat decides to go crazy on a stock that doesn't make sense, and people were, losing all sorts of savings that were shorting something that made sense to them.
Right.
I've been talking about this idea that in an interconnected world where information is completely free and money travels, we have not factored in the risk of mob mentality when everything moves so quickly. And these are the numbers that freak me out. In 2008, the last bank run, $17 billion got taken from Washington Mutual in 10 days. On Thursday, $42 billion got moved from Silicon Valley Bank in 1 day.
Wow.
This, to me, is the GameStop fiasco of bank runs, right? It's same things, right? Like, we joked about it being a bunch of nerds in their mom's basement playing video games that all of a sudden like lit a fire that turned into like a giant wildfire. Really what we were saying is, like, in one concentrated corner of the internet, something can happen that spreads and it affects the entire market, right? So in this case, I'm not putting blame on Peter Thiel, but like, that seems to be kind of like the big spark that, a tweet from a highly regarded person started this thing that, yes, it is contained at Silicon Valley Bank. It's contained right now inside this tool that they created, but it like strikes right at the heart of the confidence in banking, right? Like, Rich Ritchie just let us know that, he made President's Club this year at his bank, and they decided to cancel the President's Club trip because you now can't take this like trip to your top performers during this time of like bad optics in the banking system, right? So there's still tremors that are happening around this, even though the epicenter was Silicon Valley and like largely done. There's still tremors happening around the ecosystem. There's still things, people are on tilt. Right. If we're going to call it a poker term, right? Something else that might hit you a little bit sideways in the banking system might trigger another like aftershock. And to me, it's kind of what we've been hinting at, right? Like, we put such a premium on liquidity when it comes to investments. And in this world where money travels so quick and information travels faster, the idea of liquidity represents a new risk that we haven't really figured out yet, because these black swan events keep happening from these externalities that we could have never seen coming.
I think you're onto something for sure. I mean, you've been talking about that ever since we were talking about GameStop. And I think certain elements of that ring true here. It's a little bit different, but I think what it is, if I can add one more thing onto your point there, is when information and assets and decisions are highly centralized, that creates a lot more risk. And, you start to think about what made this crypto craze that we had a few years ago. What did people love about crypto? It was that it was decentralized, and somehow that factored into their investment decisions and all this good stuff. Like, this idea that like something centralized, when some people a relatively small number of people make the decisions that affect an entire marketplace, and that marketplace is clearly defined and very liquid, big swings can happen. Swings today can happen that were just not really feasible in 2008 versus when Washington Mutual, had that run. That's an incredible stat. I didn't know that until you shared that, man. It's incredible. So like, this idea that, what was Silicon Valley Bank catering to? A highly centralized part of the economy, a part of the, it was the tech sector. The people that are in the know in that tech sector started putting out feelers and starting letting people know in their networks that, listen, you should pull your money out. It's like this, when there's a small number of decision makers, there's more inherent risk as well. And it turns assets that we never thought were risky, like putting your money in a bank, into something that has a whole different risk profile now.
Yeah, man. And really good conversation happening in the chat between Matt Frazier, Drew Barnhill, Hervé Francois, talking about kind of like the risk profile and their, you know, whether this was like a greed thing by Silicon Valley Bank or just mismanaged risk, like they didn't have a chief risk officer, something like that. I think the most concerning thing is the idea that it's still all connected, right? Like just when it used to be that a small town bank could make a big mistake, or I don't know, man, I'm just saying this, but like, I assume that in 1995, a small town bank could make a big mistake like this, get screwed, go under. Some people get screwed. It gets contained, right? Like it's not this like contagion effect that spreads to other things, right? Like I think that's the big thing that just like really freaks me out, to be perfectly honest.
I'm with you. And it's not just to, to that sector now.
Yeah.
Every part of the economy is affected, you know.
And Matt's saying that he's saying that he's not concerned about banks. Signature is a much scarier case. I don't even know what that is. Right?
Signature is the third largest bank collapse. So
okay.
Silicon Valley Bank was the second largest behind Washington Mutual. Okay. Signature Bank was the second bank to collapse over the weekend.
Oh, wow. Okay. Yeah. All right.
So, and that's really why people are concerned. I think people, and I've read a number of reports on it, the example, and like Matt was talking about, the example of what happened at at Silicon Valley Bank seems to be kind of like a gross mismanagement of that bank. Just looking at how their deposits come in, and the fact of where they got their money, and then understanding that in a high interest rate environment, they wouldn't be able to capitalize if there was a big bank. Mm-hmm. That seems like something that was just gross mismanagement, made more difficult by the economy that we're in right now and the interest rate environment. But I think the greater risk is, how does that affect every other part of this economy, right? So Signature, I don't know as deeply, I haven't looked into their information as well, but I also know they had a similar profile as Silicon Valley Bank, knowing that they got a lot of their money, not from like depositors like you and me putting money in the bank, but from other sources, institutions, VCs. And so they lost a lot of their funding there. And it makes them susceptible to when people say, I want to pull all of my money out of the bank. And so those seem like outliers here. But what it does is it creates in an interconnected world, an interconnected environment. Now, everybody is on edge until the government and the Fed and the FDIC stepped in and said, we're going to insure the uninsured deposits. Every business owner and every person who had more than $250,000 in a bank was thinking over this weekend, I'm going to go to the bank and pull my money out. Because I don't know what my bank is doing. And so that's how everybody is affected. And that's why the government stepped in to solve this issue. And I mean, you look at stocks beyond that. I mean, the government stepped in to solve deposits, but it's not like there hasn't been a huge,
loss of wealth.
Well, thank you. Yeah. I mean, regional banks are getting pummeled and banks in general are getting pummeled, having to answer a lot of questions now, and the overall market is down.
So let's bring it home, GC. I think we're going to talk some more about the Fed in a second, but Mark Norman has the question of the day, which is, thanks for all the great information. Question, how does the current instability in the financial market affect JWB's private lending program? I would say answer that question, but how does this affect the real estate market from your viewpoint in general?
So the first thing that I thought as I was reading through this is like, man, I love owning rental properties. We are all more connected now in this world, but owning single family rental properties is a whole lot entangled in this mess, a whole lot less entangled in this mess than a lot of other assets out there. Right.
And you're specifically speaking cash flowing single family rental properties with 30-year mortgages that are not going to change anytime soon.
Yeah, exactly. Right. Like my rental properties, your rental properties, all of you who own rental properties out there, your rents aren't changing because of this, your asset value is not changing because of this. So the simple fact that we largely are adjacent to all of this is amazing to me. Helps me sleep well at night, should help you sleep well at night. And it's not a coincidence. We choose this asset because of this, right? This is not an asset like the stock market, which is highly liquid, but highly variable and highly emotional, which is what's going on here too.
True.
So I think some of the basic tenets of why we choose rental property investing, again, are showing why there's such a great asset class So I don't see this affecting single family rental properties in Jacksonville right now. I don't have the opinion that this is going to be a large run on banks. I don't anticipate that you're going to see a significant amount of bank failures in the coming days and weeks. I could be wrong on that, but I don't anticipate that.
If there was a large run on banks, what would happen to people that already own rental properties? Like,
if there was a large run on banks, your loans are already set, right? Your loans are fixed rate loans. So for those who own rental properties, you wouldn't see anything from a financial perspective. Now, if there was a large run on banks, let's be serious, there would be a lot of financial consequences all around everything we do.
Yep.
But the biggest thing to me would be, how would that affect jobs? Because jobs affect rental income coming in.
Yep.
And then how would that affect credit and capital to be able to have future purchases and things like that? So, if I'm taking this many, many steps down the line and you all say, well, how could this affect rental properties? Those would be the two things. But again, every scenario that I would place, for it to get to that level, every other asset class is going to take much more of a beating than this one would be. So I don't see any changes coming to it. In fact, you start to think about what the Fed is. The Fed is it's even in a tougher spot now, because you know how I started talking about how like the Fed knows that we need to get into a place of financial strength as an economy. We need to be prepared for the unexpected. The Fed does not feel like we are prepared for the unexpected right now because they can't lower interest rates if an unexpected thing would happen, and they can't buy more bonds and more mortgage-backed securities. They can't do more QE. So they're in a really tight spot. Prior to what just happened over this past weekend, the chatter was that the Fed had seen higher than expected job increases. They had seen higher than expected job increases, which means the labor market's hot, which is not what you want when you want inflation to come down. And they'd also seen the core measurements of inflation be stickier than they wanted. We had a higher than expected CPI rating last time CPI came out. So the chatter was that the Fed was considering raising the Fed funds rate by 0.5 point. And this would have been significant because they only raised it 0.25 point before. And they want the economy to respond by inflation coming down by only raising 0.25 point. And I was looking at the data. Oh man, I think I had it. Do you remember was it 72%? Here it is. Last week before all this, there was a 72% chance that the Fed was going to raise rates by 0.5 point. Now I might be screwing that up. It's either 72 or 80%. Let's call it 80%.
There's a high percentage that they were going to raise it by
0.5 point. It's basically the same percentage, called 72% or 80%. Of raising it 0.25 point now. So like that 0.5 point rate hike is off the table now for the Fed, even though the Fed really wants to do that because that's the only thing that they know how to do to bring down inflation. So what does that mean for real estate investors? I think that this could equate to lower long-term interest rates on mortgages than we otherwise could have expected. And like the Fed's plan was to raise rates as much as we could, which would have raised our long-term interest rates.
Jacking it up.
I see now that the Fed cannot raise rates as much as they want. So I actually think that this could potentially help keep our rates lower than they would have been on our 30-year mortgages for rental properties. And across the housing market, I think that actually can help compared to what would have been the case in a higher rate environment.
Got it. So let me kind of summarize all that, or just ask you some pointed questions. Going straight at the heart of Mark Norman's question, JWB's private lending program, is this affected in any way? JWB's private lending program seems to be staying the same way that it's always been, paying 100% of its.
Yeah, we paid 100% of our investors back with principal and interest. Our interest rate's 10%. That's not changing.
Okay, cool. Beyond that, somebody right now that owns rental properties, in the short term, it doesn't seem like this stuff is going to affect the performance of our individual assets, our portfolio of assets in the rental property game.
I don't see it affecting it at all.
It feels like if there is a giant, massive run on banks, then we have a whole bunch of problems to be worried about. What we're looking for is like insane unemployment, and who knows what ends up happening there. At that point, who knows what's going to happen if the entire banking system shuts down. But our mortgages are going to stay the same. The performance of how the assets should stay the same. The only thing that could get affected if there's a giant disruption of the economy might be vacancy rates to a certain extent.
Yeah, that could happen. I mean, it goes back to jobs and it goes back to available capital, credit.
Yeah.
So if the lending market would seize up because banks became insolvent, that would be a major issue. We had that in the Great Recession.
Yeah.
So that was a big driver of it. So
Yeah.
that would be way this end of the other end of the spectrum. I don't anticipate that happening. I don't really anticipate a string of, bank failures coming in the next week or two. But even if that happens, it would be many steps before we would have that issue.
Okay. And then based on the idea that the Fed was going from being pretty sure that it was going to jack it up 50%, half a point, to now being pretty sure that they're going to do a quarter point, that bodes well for us as far as like home prices appreciating at the rate that they're kind of appreciating right now, and the market not going, like interest rates going up much quicker as opposed to a little bit slower is generally good for the rental property investor.
Loosely, generally good. I really wouldn't make any determinations of like what's going on here as affecting pricing or things like that. I mean, there's so many things that go into it, but I think the most kind of direct comparison you can make is that if they only raise rates a quarter point and they were going to raise them a half a point, then you can probably expect that your long-term interest rates are going to be about a quarter point lower than what they would have been.
And the long-term interest rate being a quarter point lower benefits us, hurts us. Why?
That benefits us because that directly affects your positive cash flow. It also directly affects all 5 of your profits.
For future investors, for somebody that's thinking about getting a property in the next 90 days.
Yes,
okay.
For future investors.
Okay,
Great call.
Cool. Okay, good. We got that figured out. Good job, buddy. Quick question. Mike Foster, as an addendum to the prior JWB lending question, how many financial institutions does JWB keep lending funds in?
A bunch. I don't know the total number, but there's a bunch that we have, the different assets that we manage a lot of money. You think about managing 5,000 rental properties and managing security deposits for all of those rental properties right off the bat. So yeah, I'd say more than 5.
You and your partners meet every Wednesday to discuss stuff, right? Do you think that this Wednesday there's going to be a conversation around how many banks do we have more than $250,000 in?
No.
Why is that?
I think I think the Fed and the FDIC have come in and stepped in to insure uninsured depositors. And I think that was a big move. And so I think that it's highly unlikely that there would be, I don't know if there's going to be more bank failures. I don't think anybody knows. So I'm not going to say that, but I think it's highly unlikely that if there were more bank failures, that the uninsured depositors wouldn't be protected. And it's not as simple as just every time you have more than 250 in a bank account with a bank that you automatically put it into another bank. It's organizationally a challenge. So you have to kind of factor that in. So it's what are the chances that another bank that we have our funds in goes down? And then if that would happen, what are the chances that the government doesn't use this same solution that they have in place for the other ones? Sure, there's, I guess, risk there, more risk than probably anybody thought of a week ago. But then, you run an organization with 100 people and, bank accounts are paramount to where residents send their money into, and like how all of your accounts are linked. And so it's like, you got to be real about this as well, so that's the conversation.
So the faith in the US banking system is not waned to the point where it's worth going through like a huge amount of pain to just say you're out on the US banking system,
right.
Essentially.
Yeah. I mean, so like, look at whoever had money in Silicon Valley Bank, 85% of their deposits were uninsured. So it's like for businesses, it is very normal for them to have more than 250 in a bank account, which is uninsured. And as an economy, we've all sort of assumed that is a relatively safe place to play. So we've had this discussion internally, my business partners and I, many, many years ago, as we started to have bank accounts that had more than 250 in it, are like, oh, well, how specific do we need to be to protect and all of this? And it's just there's a risk reward scenario that you look into. And the reward is organizationally, you can run much more efficiently, but you are prudent with how much you put into a bank account. And when it gets to a certain level, well, you probably need to go and set up a relationship with another bank. So it's just not a one size fits all answer. You kind of have to look big picture beyond just the 250 limit.
Cool. I mean, the beauty of it, if we learned anything from 2020, is that we're going to continue to see it evolve. We're going to continue showing up and talking about it, right? Like, so I'm looking forward to seeing how this plays out. If there's more aftershocks and there's more updates that you can bring us and stuff like that, I think it'd be cool. Chris Gonzaga from the illustrious Hudson Valley asks, in Jacksonville, are you noticing an increase in multifamily housing?
Yes, there is a lot of multifamily housing that's being built. There is more multifamily supply coming online in the next year or two, even more than single family supply. And there's a lot of single family supply coming on board too, but multifamily is even more. So yeah, it's certainly something to pay attention to.
Cool. And Patriarch of the First Family asks, if a lot of people, Ken Moline,
of course,
saluted. If a lot of people pull their money from banks and bonds, would there be a rush to invest in private capital entities such as JWB Private Lending? Would this be a scenario for JWB to think about putting a cap on new money flowing into JWB?
If people are pulling their money from banks and bonds, would there be a rush to invest in private capital entities like JWB Private Lending? I think it would be a great place for people to put their money because their investments are secured by a mortgage and a promissory note, which is, and I hope you all think highly of how we run our business here and a part of it as well. But, it's nice for there to be a note and a mortgage to secure your investment beyond that, because that's more security in the investment.
And a piece of land in a, one of the fastest growing cities in America that has a really, really bright future.
Yeah, you don't have to just listen to me and tell you that things are rosy on the balance sheet of JWB and all this good stuff. Just like for the bank of Silicon Valley Bank, Silicon Valley Bank, he got on the call on Wednesday and said, hey, things are fine. Nobody believed him. The difference with private lending is, you have recourse. If for any reason your investment did not go according to plan, you get an asset back. You take the house back. And, unfortunately for the investors of Silicon Valley Bank, they don't have anything now because the bank failed. So anyways, to your point, I would hope people would look at private lending as an alternative in an environment like this. I don't know. I mean, I've never really been a part of a scenario where there would be a major run on banks or bank failures or things like that. I would tend to think that in that environment, people are just losing their heads and they're sticking their money under a mattress, and people will have a hard time making sound financial decisions. So that's what I think would probably happen.
I was on a call yesterday with like a big VC guy, right? Like, one of the category design advisor guys. And he was just like, you know what? He's got this deep raspy voice. Like, I've just been telling people I'm going to buy a bunch of gold bars. I'm going to bury them under my house, but you don't know what else is under my house. I guess, right? Like I was just like, listen, dude, what I'm doing is buying workforce housing in a blue collar area of a city that has a very well balanced economy, and it gives me cash flow and it allows me to use leverage and these different things, man. So I don't know, man, maybe this type of stuff starts opening the door to this idea that we've been talking about, that the 60-40 portfolio hasn't been working for people the way that we've thought about it. And, maybe in that safe part of that 60-40 portfolio, you really got to start thinking about cash flowing real estate properties that, you start putting that stuff into and start putting things out of the market or out of other things because gold is great, right? Like gold, cool. Gold is probably not going to lose money for you long term, but at the same time, it's still just like a piece of thing underneath your property that you can't use for other things at all, right? Like it
can't be your strategy of becoming financially independent.
Correct. It's not a financial independent strategy.
Yeah. I mean, I think this asset class, rental property investing, has been told all the negative things about it forever. And then when the pandemic happened, everybody's like, oh, this home prices are going to fall and rents are going to fall. Yeah. And all that happened was we collected 98% of rents. And all that happened is home prices went up. And, in an environment like this today, where the financial world is on fire because of the second and third biggest bank collapses in history that happened over a weekend, I can't think of a better asset class to be in than single family rental properties. Yeah. I mean, and there's still articles written about how it's risky to invest in real estate and how home prices are going to crash and all this other stuff. None of that's actually happened. US rents have never gone down in value, even during the Great Recession. Never happened. Rents are expected to continue to appreciate. Home values have gone up almost every year. The only years that they haven't gone up since 1982 were those Great Recession years, which was that was an anomaly. But home prices have gone up the vast majority of years. and home prices are still going up year over year right now.
Yeah.
So there's like all this negatives, and then it's decentralized, right? Like let's use a crypto term here.
Yeah.
You guys are searching for like a decentralized asset. Well, that's called single family rental properties, because owner of single family rental property on 123 Main Street does not coordinate with the owner of 126 Main Street, like.
And they would have to coordinate from like 2 Main Street to 400 Main Street.
Yeah, exactly. Right.
Yeah.
So it's like, it's highly decentralized and fragmented,
Mm-hmm.
and there is illiquidity built into it, which you and I have been on this campaign of showing people like liquidity is not all it's cracked up to be, right? There is beauty in illiquid, right? Illiquid assets. And there's beauty in just boring businesses. Right. Yeah. Let's just call it a boring, unsexy business.
Cash flowing.
Yeah.
Unsexy
We're
business.
Talking about single family rental properties.
Yeah.
Like that's where I want my money, in a highly centralized, highly connected, highly emotional investing world right now. I want to be adjacent. And that's where we are for rental properties.
Yeah, man. Lee's saying he likes that whole like decentralized thing. Like, yeah, man, it's funny because they talk about, I was having this, I went to a male baby shower this weekend. I think everybody should know, right?
All right.
Went to Kurt's baby shower.
There you go.
And we're all talking about, so me and Nick bought Kurt's daughter $100 of crypto, $100 of Bitcoin, right?
Nice.
So we had like a crypto conversation. And basically everybody was just like, yeah, if it's not Bitcoin, I'm kind of out, because we don't really know what's happening. But at the end of the day, at the core of this whole like Bitcoin thing is this idea of like mistrust long-term of a specific government and, like decentralization, right? And like unhackable stuff. Like I completely agree with your take, right? If you want to really talk about something that's decentralized, yeah, those bars of gold are probably a good equation of that. But, a single family home that is a core necessity, right? Like it's like buying toilet paper in the pandemic. Right. Somebody needs to use it. Like you're never gonna not use that thing, which is workforce housing, right? It's these like neighborhoods that are below median income, livable neighborhoods in a city with a bunch of jobs, in a economically diversified verticals that has been one of the 10 fastest growing cities for the last 10 years and has an urban core that's about to come online and Fortune 500 companies building headquarters in it, like.
There you go, making it sexy. You're making it sexy, Mr. Hype Guy. I'm not even talking about all that extra stuff.
You're not talking about that extra stuff, but to me, like, it's just like, what could happen? What is the contagion that could happen in Jacksonville that is only to Jacksonville that could disrupt that whole thing? It just seems very unlikely, man.
Yeah, I mean, certain things could happen that could disrupt it, but then you also have insurance in place, right? Like a natural disaster.
Yep.
Right. But then you have insurance in place, right? Like there's no perfect investment out there, but there's certainly not insurance for what investors of Silicon Valley Bank just gone through, or the hundreds of millions of dollars of wealth that has been lost through the banking industry right now. There's not insurance for that, So you start to think risk and reward here. And, if you'd asked me a week ago, what was more risky, putting your money in a bank, I would have said that's extremely low on the risk profile. Now, depending on how that bank operates, that I think that bears some additional due diligence, unfortunately. But rental properties, this asset class just performs well. And I've done this for 17 years. So I've seen the Great Recession. I've seen a pandemic. I'm looking at this now. I can tell you that rents are not going down. We haven't had one call from our residents who are like, my life is affected by Silicon Valley banks, and Signature Bank going under. So it's like, there's beauty in that. It's not by coincidence. You choose to put your money in an asset like this, and then you're rewarded in times like this.
Yeah, it makes me think of how it worked for you even in the worst moment, right? Like 2006 to 2010, it worked. It was resilient in the thing that was a crisis about the thing.
Right.
And it worked out. All right. Last couple of questions, and we're going to wrap it up. This has been an awesome show, man. First of all, Denny Davis says, come on, Gregg, you and Pablo make it sexy. I agree with you,
Denny. We do make it sexy, don't we?
Yeah, we keeping it sexy.
Thank you, Denny.
I meant to hug you back. You
didn't even want to hug me.
I don't want to make it too sexy out here. Okay, we have Eileen Mateos is asking, what is JWB purchasing with the note/hard money loan investment that investors can participate? Or like, what does JWB purchase with these private lending programs?
We use the money to buy the land and then to build the houses that turn into the turnkey rental properties that we sell.
There you go. So that's why you say that it's backed up by a piece of land, right?
You get a note and a mortgage on that specific property, and that's security. And then, of course, we've borrowed over $300 million and have paid 100% of our clients back with principal and interest. Never once had a failure there. So you've got that working for you. But then in a worst case scenario, it's good to have a mortgage and a note as well.
There you go. And not your average guest. This is the first participation. So if you click in from your text reminder, you popped in here as not your average guest. So I don't know what your name is, but asking this question: do you see Fed/Congress limiting working Americans' abilities to leave traditional banking and go to private style investing such as JWB?
Do I see the Fed or Congress limiting working Americans' abilities to leave traditional banking and to go to private style investing such as JWB? I haven't really thought about that. My initial gut reaction is no, I haven't heard, or I don't see that happening. Would like it. I think everybody would be better served if they knew more about opportunities to invest in rental properties or private lending with companies like JWB. But no, I don't see a big push of that.
A big push of limiting them. Listen, when I read that, I get freaked out, right? I'm Venezuelan.
Yeah.
Sure. As if the US government were to ever say, you can't take your money out of your bank because of X, because I command you to do this.
Yeah.
I don't know what we would be going through.
Yeah.
I feel like that is the opposite of what our society is based on. And we're like the shining beacon of the world of not doing that.
Yeah. That's a good point.
I would say I would never see the American government doing that. But every society that's gone through a revolution says that before that happens, right? But it would be a significant revolution, right? Like this would be completely against our way of life for our government to limit our money flow.
Well, I think it's a valuable perspective, and I'm glad you brought that up.
Yeah.
The thing that I would hope is that not necessarily limiting people's ability to leave or doing things like that, but making alternative assets like rental property investing more available.
Yeah.
Like, for example, through company 401k plans, which certainly they're promoted in different ways through the government, but that all you can invest in there are stocks and bonds. Yeah. Generally. So, what I would hope is that alternative assets like rental properties or private lending have a seat at the table more than being shut out largely, which is what they are right now.
That would be American.
There we go.
Increase options, increase market, increase competition, allow people to, a fair shot at alternative assets that have been proven to work for people with providers that have proven to be able to deliver. That to me would be a very American move.
There we go.
Right. So not your average guest, we think the exact opposite would be what we would expect our government to do one day based on these lessons. I think that's a good way to end on it. JWB is America.
There we go. Love that.
I think next show you wear like a Hulk Hogan kind of like tank top, rip it off at the beginning.
You can be Macho Man Randy Savage?
I'd rather be the Ultimate Warrior. That's my guy.
Yeah, he was awesome. All right. Sounds good.
All right. That was an awesome show, man. We had 80 plus, a new record for a Tuesday show, man.
Love that. Way to go.
80 plus people.
Way to go, all of you out there. Thank you for being here.
Amazing conversation inside the chat. Just like this is a chat that I'm going to download and read because I feel like I need to just learn from our community. Really, really intelligent people like Matt, like Drew, like Leo, like Lee, just in there, just dropping nuggets nonstop of all these like really, really interesting things. So thank you for being here. Thank you for making these not your average insights the thing that we most look forward to, right? Like showing up here and riffing with you is way more gratifying than showing up like, what are we going to teach, Greg? So really, really a lot of fun. And I appreciate the community doing this. If you're listening on the podcast, come join us one day, right? nyais.com. And join us. GC, last words.
Just appreciate all of you for being here. You make this super fun. I think every time we do one of these shows that is kind of hitting on a super like timely, urgent topic, it's kind of a big thing for Pablo and I. And so to see all of you guys show up, this is kind of the momentum and kind of where we want to take elements of the show, is to be not just teaching the fundamentals here, but being there for you when something super timely comes up and maybe relating it to other things like other asset classes. So I think today was just a really big step forward. Appreciate all of you for being here and for being such a big part of the show. And yeah, can't wait to see you guys on Thursday.
See you Thursday at the JWB Rental
Week.
Remember, if you want to invest in a truly decentralized asset, you can't think like an average investor. See you Thursday.
See ya.